Would you like to know, step by step, how to go about building your very own customized Trading 212 pie? If you just said yes, today's your lucky day. If you just said no...
All right, what do you think, a bird with a long neck?
Blackbird.
I'm going to risk saying it. If it's up there, I'll give you the money myself. A blackbird.
Hey guys, I'm Jasper, a financial market analyst working with Trading 212 to help improve your financial education. Please note that nothing in this video should be construed as financial advice. Today, I want to hand to you, loyal viewer of Trading 212 YouTube videos, the skeleton key for building your own personalized investment portfolio using Trading 212's market-leading technology. What exactly you put in your portfolio is highly personal, so my goal here is to offer some ideas on how to categorize your investments and how you can use pies to get them in order. I think there are probably two types of pie users. I think of them in terms of apple pies. Mama's apple pie investor.
Oh, this beautiful apple pie.
And the Mr. Kipling apple pie investor.
They are exceedingly good apple and custard pies.
Mama's apple pie users, they just bake one big giant pie and put everything in there. Their pie is their entire portfolio. Mr. Kipling's pie users, they like a few different pies, all serving different purposes. All the smaller pies added together make up their portfolio. But I don't have any favorites. I love you guys all equally. This video is for everyone. Okay, the first and foremost way to categorize a pie is by risk tolerance. What is your appetite for risk? This might sound like a bit obscure, but deciding how much risk you are willing to tolerate is key to building a portfolio that works for you as a person. The beauty of pies offered by Trading 212 is that the visualization of your portfolio as a pie chart makes it much easier to see exactly how exposed you are to different types of stocks, and moreover, the balance between riskier and safer assets in your portfolio. There is a well-known and inevitable trade-off in finance between risk and reward. To gain the possibility of significant returns, you have to tolerate some level of risk. This is because there is no such thing as a free lunch, and if there was a great way to make returns without taking any risk, it would have already been discovered and fully exploited long ago. In financial markets, to gain something, you need to be willing to risk something. Okay, enough with the metaphors. I always feel better if I can give you something practical to take away and use. You need a way to measure risk, so let's talk about one way to find risky and less risky stocks.
To live is to risk it all.
There are different ways to measure risk, but the one I always fall back on is beta. Beta measures a stock's volatility, that is the degree to which its price fluctuates in relation to the overall stock market. If you're buying a blue chip stock from the UK, then the benchmark index from which to judge the beta of the stock is the FTSE 100. Let's say the FTSE 100 moves 1% on a particular day. A stock with a beta of 1 should also move 1%. A stock with a beta of 2 would move 2%, and a stock with a beta of 0.5 would move 0.5%. Beta innately demonstrates the relationship between risk and reward. If you own a high beta stock, you're exposed to more potential upside in a strong market, but also more potential downside in a weak market. Tap on any stock in the Trading 212 app and you'll see beta listed under info and stats. Mama's pie people, if you want to take more risk than the overall market, you can tilt your pie towards stocks with a beta of greater than 1. If you want to play it a bit safer, choose mostly stocks with a beta under 1. Mr. Kipling's pie people have two pies. One is your low risk and one is your high risk. Okay, now the next big picture question for what goes in your pie is asset class. What sorts of assets do you want to include in your portfolio? A well-diversified portfolio can include several types of assets. The different types of assets available to include in your pie have their pros and cons. Here I'll talk about the three most popular types of security for individual investors. Shares. These, as we know, entitle shareholders to a share of the profits of a company and participate in future growth. The profits are shared out as dividends, and there is a possibility that the share price will rise as the company grows, meaning you can sell it later for more than you bought it for some capital appreciation. Now, both of these potential benefits of owning shares have to be balanced against the risk that the company will either not grow, will fail to make profits, or in the worst case, will actually go out of business. In any of these situations, the reward for holding the stock will be low or non-existent. For this reason, stocks bring the potential of upside intermingled with risk. This is why stocks have classically been balanced against other assets in a well-diversified portfolio. ETFs. Exchange-traded funds are effectively just baskets of securities. Once bundled together, you can buy and sell these baskets on the stock market just as if they were individual stocks. There are ETFs for almost any taste, and they are a fantastic way for investors to diversify their portfolios. You can hold ETFs within a pie exactly as if they were shares. In fact, you can make a pie composed entirely of ETFs if you want. ETFs can be especially useful to gain exposure to asset classes other than shares without having to own these more cumbersome assets directly. Everything from bonds to real estate to gold and other commodities, and even private equity can be bought via an ETF and sold anytime. Bonds. Traditionally, stocks were always counterposed to bonds, with stocks bringing the growth potential and bonds being used to guard against downside risk. This is because bonds have a fixed and predictable stream of income linked to them, the coupon payments made to the holder, before the principal sum is returned when the bond reaches maturity. These characteristics mean that while bonds generally offer lower returns than stocks, the returns are predictable and continue even when stock markets are performing badly. Bond funds or bond ETFs tend to be the most popular way for individual investors to get exposure to the bond market. Okay, so Mama's Pie people, you need to decide how much of your portfolio will be individual stocks, ETFs, and bonds. The traditional 60-40 portfolio split means 60% of your portfolio in stocks and the other 40% in bonds. If you had a single pie which for argument's sake had £1,000 in it, you could choose a mix of stocks and index funds to invest £600 in and a few bond ETFs to invest the other £400. Mr. Kipling's Pie people, if you like, you could set up 3 separate pies, a stocks pie, an equity ETF pie, and a bond ETF pie. In your fictional £1,000 portfolio, the first 2 pies would add up to 600, and the last one for bonds would be 400. Now, going back to the first point on risk, if you have a higher risk tolerance and don't want to allocate so much to bonds, you simply reduce the size of bonds as part of your pies. Right, let's round things off with how to go about picking the individual stocks for your pie. In a future video in this series about pies, I'll talk more in depth about weighting and rebalancing stocks in your portfolio. There are lots of considerations there, from domestic versus foreign, small cap versus large cap. For now, I just want to help get you started. It might seem daunting to consider how to start building your own pie, but one way to start is to begin thinking about how you think the world will have changed in 10 years' time. The example portfolio described below is of course simply an illustration of how the thought process behind building a portfolio might work, and not an off-the-shelf recommendation. From this broad question, a few ideas might start to materialize. For example, that you expect the decline of the high street and the rise of e-commerce to continue. Based on this, you might decide to include Amazon shares in your pie, since Amazon is a current leader in this space, and it seems plausible they'll continue to be a leader for several years to come, but as successful as Amazon is today, there's nothing to guarantee this will continue forever. For this reason, your portfolio needs further diversification by investing in different kinds of companies. This could be the right time to add an ETF to your pie, and one that represents a broad basket of companies to spread the risk. If you live in the UK, you might decide to use the FTSE 100 share index as an ETF. The FTSE 100 index is made up of the 100 largest companies traded on the London Stock Exchange and contains names like Barclays, Marks & Spencer and Tesco's. So now, as well as backing Amazon, you've included in your pie an ETF that will track the movement of 100 large UK companies, some of whom are direct competitors to Amazon. In this way, whether the high street or e-commerce wins, in the long run, you'll have some exposure to each. Alright, so in review, you can ask 2 key questions to help plan out what will be in your pies: how much risk you will tolerate, and the mix of assets you will include, namely between stocks, ETFs, and bonds. But that's just how I go about things. How do you account for risk in your portfolio? Do you have a 60-40 asset mix, or will you use something different? Let us know by leaving a comment. And if you like this video, please make sure to smash the like button, subscribe, and hit the bell icon so that you see more videos like these as soon as they're released. Thank you very much for watching, and happy investing.